Hey guys, welcome to another episode of the PVP podcast where we talk about real estate, business, and everything in between. And today we're talking about mortgages. I got Camilo Rodriguez with me, the founder of the Mortgage Lab. He's a senior mortgage broker in Canada. And Camilo, thank you for coming on the show today.
Giancarlo, it's been a pleasure here. Thank you for the invitation. I'm really pleased.
I appreciate it. So talk to me a little about who you are, where you come from.
Um, Giancarlo, by trade, I'm an electrical engineer.
Wow.
And
Okay.
a long time ago, I decided that I possibly could be the worst electrical engineer because I didn't have a passion for the industry at the time. I didn't like being an engineer. I used to be assigned a project and I will try to rush it in the first 2 days or 3 days of the week, so I didn't have to do anything on day 4 and 5. And then I reflected about it and I go, this is not right. This is not something that I should devote the rest of my life to. And that guided me or sent me in the direction of real estate, and mortgages was my first stop. And since then, I've been buying real estate. I've been uh, investing in real estate, investing in mortgages, but mainly building up Mortgages Lab, which is the company that my wife and I founded about 12 years ago.
Amazing. Amazing. So you founded Mortgages Lab 12 years ago, but how long have you been doing mortgages?
Oh, I've been doing mortgages 23, 24 years. It's been
Wow.
a long time. To put in
Okay.
perspective, I used to have lots of hair when I started. And so that's my, yeah, it's been a long time. It's been a long time. I love it and it's been a long time, yes.
Amazing. Amazing. Now, what type of, before you started doing mortgages, were you working directly for a bank or were you working just for a mortgage brokerage?
I follow the path. I think destiny put mortgages in my sight because right after I became or I decided to leave electrical engineering, I got a position as a financial planner, and I did that for about 3 years. And in my prospecting, I wanted to meet more mortgage brokers or mortgage specialists, and that led me to meet a really cool guy that invited me to work at TD Bank as a mortgage specialist. So I
Okay.
started my career in mortgages at TD Bank, and I worked with them for 3 years. And I love to tell this story because I went hunting, like I was looking for business for insurance and investments through that relationship. And he ended up hiring me, so I became the prey. And we always used to joke a lot. He just really liked the fact that I was doing a structured presentation. I was presenting my case. I was handling objections. And that led me to a really cool job at TD Bank that I did for 3 years. After that, I just became a mortgage broker because I saw the opportunity. I always wanted to grow and learn more. So I became a mortgage broker with another company, and that was for 4 years prior to me deciding to start Mortgages Lab as a brokerage.
Amazing. Amazing. So, I mean, you've been doing mortgages long enough. You must have seen all kinds of rates.
100%.
Yeah. So tell me about like some of, like 20, 23, 24 years ago when you started mortgages. What was the rate then? If you remember.
I'll tell you, I remember by heart because that was the rate I got. I got 8.5%
Wow.
on a 5 year term mortgage. And the worst part of it was that I loved it. I loved it that I got the approval and that I was going to pay at that time the same or a little bit less with my mortgage that I was paying in rent. So that was my way in. So 8.5%, basically what people consider today to be
Extremely high.
extremely high. Yeah,
Extremely
100%.
high. Yeah. Yeah. I think that like a few years ago, 5 years ago, we went through COVID and mortgage rates were at historic lows.
Yes. Oh, yeah.
1.99%, I remember. I believe it was HSBC that was offering that, and I remember I couldn't believe a mortgage rate at 1.99%, and people were getting really excited, and I was saying, this is not realistic, you know?
It's not realistic, and people, we all think short term,
Yeah.
Giancarlo. We all think short term. And I remember at that time, I remember in hearing conversation, you would offer them 1.99, and then the client will get back to you, oh, but I can get at TD Bank or at Scotiabank 1.89. So, so if you can imagine, we have been conditioned so much about the mortgage rates that regardless of the rate, you're always negotiating a little bit
Down.
less down, okay? Because you think that that may make the difference over the length of your mortgage. So yes, those was very, very low rates. In hindsight, we should have taken at the time 10-year fixed terms that you could get for about maybe under 3%. That would have been the best deal ever. But I think very few people in Canada saw the rapid inflation coming up so fast, and the way it happened. Very few people. I can say that most people wouldn't see that happening. Everybody thought that rates will stay in the same range, just going up a little bit slowly, and
Yeah.
inflation came and everything changed.
Yeah. Yeah. And I know that, like, I've only been in real estate for 10 years. And sorry, this is going to be my 11th year, since 2015. And I've seen the market in terms of mortgage qualifications change. I remember 2015 when I first started, it was super easy for people to qualify. There was less stress tests, there was less, like qualification points that they had to meet. There was also more promotions. Like, for example, I'm in Montreal, and there was more promotions where, like, to encourage the sale of new development condos, developers were offering kind of like a I don't want to say buy with $1,000 down payments.
Yes. Yes.
I don't know if you remember some of those, right? Now there's no more of that.
Even prior to that, Giancarlo, there were programs with CMAC with 0% down. I remember doing approvals where the client only had to show income and good credit, and they will get an approval. No mortgage. The mortgage actually started to be higher than the purchase price because of the CMAC insurance, default insurance. So, and people bought that and they did amazingly, just because the market kept appreciating.
Yeah, with the equity and everything, for sure. And now it almost seems like there's more qualification points to meet. There's stress tests. So there was a point where, couples were getting refused from, or didn't qualify. What does it look like now for a couple who wants to qualify for a mortgage in Canada? Like, how does it look?
It's still like the market in Canada is still really good. It's really strong. It's really liquid. So there's tons of money to be lent out. Like you said, the qualifications have changed dramatically. To give you a perspective, when I started, I remember a program, for example, with a major bank like TD Bank, and other banks had similar programs. You would have 35% down. You show your down payment, just a screenshot that you have the money. You show a notice of assessment showing that you owe zero to Canada, no taxes. Boom, approved 65% best rates. 65.
Amazing.
That could happen today, but at what I called private money or maybe investment funds, okay? But not at the institutional level. But right now, to answer your question, right now is challenging because a lot of people, of course, remember previous applications, previous approvals, and they're shocked that right now is way harder when they started, even though they make more money, they have more equity, they have more assets, they're in a better financial position, they have a better home. It's still more difficult than when they started, which is something that I believe Canada has to really think about. Okay.
I think so too. I definitely think so too. And the reason why is because I remember, at the beginning of my career, which was 11 years ago, two people working as waiters in a restaurant earning $70,000 a year together, right, were able to qualify for a $300,000 mortgage. Now I think it's almost like you need to earn $120,000, or 105 or 100 or 95, whatever that number may be. Maybe you could confirm that to qualify for the same mortgage amount, right? And I think that everybody has the dream of owning a home.
I believe that.
And I find it's almost unfair to the common workers, like people who work in restaurants, that make $50,000 a year. And I find it's hard. I don't want to say unfair, but discouraging for them. Whereas 10 years ago, two people, a waiter and a waitress, I remember because I was selling homes as a real estate agent in Montreal, and I was seeing these couples, and they were able to purchase $300,000-$400,000 homes. As today, it's a bit more difficult, and it discourages people a bit more. And I think Canada needs to do something about that. Like you had said, right? Maybe some sort of incentive, promotion, remove the stress test, maybe work on the inflation, but something must be done.
Yes, and I think Canada at the macro level is going to help a lot by providing supply, because all of this happened because there was a huge demand and not enough supply. And I think what the government tried to do, instead of increasing the supply back a few years back, what they did is they tried to restrict the demand. So they take away foreign buyers. Demand is out. They increase the stress test. Now a lot of people don't qualify. They make it harder for the banks to qualify. More people don't qualify. So the demand is there, but they cannot buy because they don't have enough supply and they need to control it. But right now, I think the new government is going to increase the supply drastically. And you're starting to see right now in cities like Toronto and Vancouver, prices going down in certain real estate categories, going down 2 years in a row, just because the demand is being restricted or keeps being restricted, and the supply is increasing. So now you have empty. It's weird, but they try to manage it and they create a chaos, because right now developers are losing money. People have fear because prices are going down. They want to buy at the bottom of the market. Who knows where the bottom of the market is going to be? And everybody, of course, thinks short term. And they always get confused. I think it's very important to have clarity, because one day you have people saying, Camilo, yeah, the prices are right, but the rates are too high. Too high for what? For their own liking, but they're too high because they may have heard their neighbors quote a lower rate from 4 years ago. But they don't know that prices are lower because rates are higher. They are inversely correlated. And if rates go down, that has pressure on real estate values. So now they will be forced to compete for properties. At the end of the day, you just have to think what your family goals are and go for it, or what your real estate goals are, or investment goals, and go for it. I've done a little bit of research, internal data from my office. I don't see any year in Canada where if you hold a property for the long term, let's say 10, 12, 15 years, even in 2008, even if you bought at the peak and then the following day everything dropped and things went to chaos, that 10 years later they're not super happy with money-wise, equity-wise, with their purchase. There's not a single year. But everybody buys today thinking or assuming that they're going to sell in 1 year. So of course they want to buy if they believe that prices are going to go down, right? So anyways.
Yeah. I mean, do prices really ever go down unless there is a drastic market shift? Very drastic market shift. Do prices actually go down? We see them, I don't know, like go down. Stabilize, maybe, I think is a better term. Like in the last 5 years, I've only really seen prices go down on condos, right? Because there's so many of them. For example, Toronto's a great example. developers are going bankrupt, because what happened? Well, we put the restriction on foreign investors to try to cool the demand, like to cool the market down, to give civilians and citizens a chance, right? But then, like, if you go to Toronto today, it's filled with towers that are half built. Literally, you see 50, 60-story towers with the glass halfway through the tower, the crane's still up in the air. It's kind of like they just stopped, and I recently saw on the news a few months ago, developers were offering promotions, 0% interest rate on the purchases of 1-bedroom condos for the first 3 years. Like they're but in terms of houses and revenue properties, this is completely different from the condo market, I find. So every asset class has its own internal market, Yeah.
And for me, I like to try to summarize it and make it simple. It's very easy. In my own mind, it's very easy. It's just supply and demand. You say, for example, that you don't see homes or houses go down in value. Yes, in Vancouver, they are going down in value, houses. But which houses are going down in value? Houses that are worth $3 million, right?
When they're really worth two, let's say, in
Well,
reality.
no, it depends on the demand. So if the government didn't take away foreign buyers, who are usually wealthy individuals that buy those type of homes, those homes will be still going up. But they take away the demand. And the second part is for local people to qualify for that mortgage, even if it's worth 3 million, they cannot qualify for financing because the income that you need to make in order to qualify for a regular mortgage for that is the 1% of the 1%.
Yeah.
So now what's happening is for those assets, there's no buyers.
Yeah,
Only
there's no
lateral
buyer.
buy, maybe a person selling and buying
Yeah.
something. Just there's no buyer. So it all depends on supply and demand. But I always keep right here in my drawer, I have a coin because it makes me remember that for me, life is always two-sided. I always see up and down, black and white, male, female. Everything is like dual. So I know that right now there is huge opportunities for the ones who want to look at the other side.
Yeah.
Never in your life you can go and argue and win with a developer. Never in your lifetime you can do that.
Yeah,
When
never.
can you do it today? But people are not doing it because they see the other side. They see the fear side, not the opportunity side, right? I think there's huge opportunity right now in every market just because you can do creative financing, you can do negotiation. In Vancouver, not a few years ago, the property is listed for 700,000, is worth 700,000, and you had to start the bid at 720.
It's funny you mentioned that. I was just filming another podcast episode before this, and the guest that I had on before this, we were talking about real estate during the COVID era.
Yes.
And I was an active real estate agent in 2020, 21. And although it was some of my best years sales-wise, I was seeing people bidding on houses, not revenue property where it generates income and, rentals, houses. They were asking, I remember this one house, I'll never forget it. They were asking $600,000 in a suburban area west of Montreal, and they sold for $929,000. Houses where a husband and a wife want to raise their kids. And I'm thinking, yes, okay, your mortgage rate is 1.99, 2.1, whatever it was, but you just bought, spending an extra $329,000 on a home, that's like you bought a whole other house in certain markets, or a condo, right? You could buy a whole other property for that much more. And I'm thinking, what happens come renewal time? What happens when the house, it's inflated because of demand, but is it really worth $929,000? Maybe in 2020, 2021, when you have 35, 40 offers on one property. But what about today, 2026?
I think it's all about emotions management. Um, I didn't like those deals, and it's weird because nobody, very few people in that environment will stop to think, should I buy this and offer more and more and more and more? They just see everybody offering, they wanna win the bid. So it becomes emotional, and they think that because the market is going like this, it's gonna continue like that, right? So similar to right now, people do not buy because maybe the market has pulled down. It's a buyer's market. They don't want to buy it, but because they assume that the market is going to stay like this. If there's anything that is constant, is change.
Yeah.
Rates always change. Values of real estate always change. The only thing that in my mind does not change is owning an asset over time builds equity. So most people should be thinking about building the equity. And one of the topics that I'm um, super excited to talk about is a concept that I write in my book, From Debt to Zero, which is the cost of credit. Everybody is so focused on the interest rates because they assume that if they negotiate a low rate, similar to if they negotiate, the price, they assume that that is the best financing that they can get, the lowest cost of financing that they can get. And if they read my book, they will realize that it's not always the case.
Yeah.
Cost of credit should be a number that you have right in your mind every week, because that's the total amount of money that you're giving the bank over the length of your mortgage. If you don't know that number, you cannot manage it, you cannot minimize it, you are at the mercy of the banking system and your lack of knowledge, basically.
Yeah. It's interesting because I'm part of a mentorship group, and when interest rates were rising, I've been part of this mentorship group since 2022, and right at the beginning, where after the COVID frenzy, interest rates were rising. And one of the things that the mentor said was, a lot of people look at interest rates, but that's not really all that matters. Deals are still doable, right? An asset is an asset. You could still make money off of it. People say, oh, I'm not going to buy now because interest rates went from, 2% to 3% or 3 to 4, right? Of course, it does make a difference in some examples. Like, I'll give you a great example. During COVID, I bought a condo in Montreal, and I bought a pre-development condo. And when this condo was being built, I had qualified for a mortgage at 2.49% in late 2020. And when I did my calculations and everything, the condo fees, the carrying cost, mortgages, everything was coming out to $1,300. And I could have rented that condo for $1,600. But then what happened was, by the time I closed on that condo, the developer told me, you need to close, or you need to requalify. But the problem is, I knew I wasn't going to requalify for the higher rate and everything, so I had to force the close on the condo. But it was no longer a 2.49% interest rate like it was in 2020 when I first got qualified. It was now a 4.84% interest rate. And all of a sudden, that condo that was going to cost me $1,300 all in, mortgages, taxes, insurance, everything that I could have rented for $1,600 is now costing me $1,560 for just the mortgage. Never mind the taxes, never mind the condo fees, just the mortgage, right? But the part is, it was still only able to rent for $1,600 a month, right? So in some cases, maybe it does apply. In other cases, I think that people need to not only look at the interest rate, because there are ways where, and maybe you could correct me if I'm wrong. This is a question that I want to ask you, but if you make one extra mortgage payment a year, it makes a difference on the term, the lifespan of the mortgage, does it not?
100%,
Yeah.
100%. Um,
Most people don't know that.
People don't know that. And as I said before, in my book, I called my framework, one is amortization compression. One of the best ways to save on the cost of credit is reducing the number of years. If you do one extra payment, you'll probably save 2 or 3 years of your total amortization.
Yeah.
And what people don't understand either is that that extra payment, let's say you did $1,000. This is why this is powerful. $1,000 payment to your principal. Okay, you don't have to, and let's say you have 25 years left. Because of that $1,000 you put into your principal, now you don't have to pay interest for the next 23 years on $1,000.
Yeah.
It's not only the interest rate, it's the compounding of that because you have that year, the following. Now you don't have to pay interest on that. And that helps reduce the cost of credit dramatically. So yeah, big time, Giancarlo. That's a very good strategy. And there's
Yeah.
another strategy. If you have a home and you have an investment property, and I wrote it in chapter 8 of my book, I call it Rental Lab, you can create an additional deduction besides the ones that you have on your rental property, the normal ones. You can create an additional deduction via strategy that is called cash damming, and you start to get refunds that are going to help offset the negative cash flow that you may be experiencing in the first years, because there's money back from the government that you can use to offset those expenses. Okay, so there's still ways to fight back and to bring it back, because if there is one piece of advice that I can give anyone is buy something and hold on to it for the long term. When I see people, I'm not giving advice in real estate because I don't have a license, but when I see so many mortgages and I look at the equity of those people, I always see that the longer you hold on, the more equity that you have. And I've seen people buy, sell, buy, sell, buy, sell, buy, sell, and sometimes they stop because they get tired or the market is not good, but they don't build as much equity as if you just buy, hold. It's boring, and maybe we just follow Warren Buffett advice. He says that all good investments should be boring. It's boring, but over time, and it's happened to me, you wake up one day and you have $200,000 in equity.
Yeah.
And you just kept the property, right?
And I like buy and hold more than fix and flip. I like buy and hold because it's easy to project your earnings and your equity gain and your cash flow. Projections are a lot easier. Sure, it's slower, but it's a lot safer. Fix and flip is, yeah, you get big profit injections when you flip the property, but the risk is a lot higher. If you don't buy it right, you might not make the proper profit. If you do buy it right, sometimes you might not meet the renovation budget. Renovations are never on budget. You know, there's always a surprise. I just finished doing a renovation in one of my buildings where it was supposed to cost us, X amount of dollars, but it costed us $2,000 more because we had to replace a beam and we had to replace this. It's not, believe me, a lot, but when you're doing fix and flips and you budget $50,000 for renovations, but then you end up spending $68,000, well, that $18,000 comes out of your profit. And if you're only making $25,000 profit on that flip, minus the surprise 18,000, that's where I prefer buy and hold because it's a safer, boring strategy.
100%, 100%.
So tell me about the Mortgage Lab. You started this not some time ago with your wife. Where did the idea come from? Where did the name come from? I see you're wearing the lab coat too, so.
Um, I love to read books on marketing and branding, and it was an idea that came from one of the books that I early read, and I always, like anything in life, in my opinion, nothing is finished. Everything is a project. So when I went into mortgages, I wanted to become really good at mortgages, but it was always never ending. It was like trying out different things until you find your craft, and you keep trying and you keep refining, you keep learning more until when? Until, in my opinion, until you die, because that's
Yeah.
the only time that you can stop. So that's where the name came from. And I'm wearing a lab coat. When I was president of the BC Mortgage Broker Association, the marketing manager at the association loved the name of my brokerage. And he showed me a report from one of the leading US companies, I think it was Harvard or Yale or somebody, and they did a test where they have two people asking the same questions, one with a lab coat, the other one without a lab coat. And they realized that we are conditioned to, because of doctors maybe, or because of nurses, to follow instructions with people from a lab coat. So he said, Camilo, you should start using a lab coat. And I've been using it, not because of the conditioning, but because of the branding. And clients love it, referral sources love it, everybody loves it. Gives a good laugh, and I always tell the story that because I'm wearing a lab coat, now you're going to pay attention to me and you're going to follow my instructions, and they all laugh, and we get going with what we're trying to achieve. That's the story of the lab coat and the name of the brokerage.
That's amazing. I mean, I know that branding is really, really important. I think that brand is, everybody needs to have a personal brand, unique to them, right? Very unique to them. And I think that it's extremely important. So it's great that you do that. And, in here in our local real estate market, there used to be this guy called Cal Boyd. And his last name was Boyd and his first name was Cal. And he used to wear a cowboy hat. Because if you say his name fast enough, it sounds like you're saying cowboy.
Yes.
Right? But Cal Boyd used to wear a cowboy hat, and on all his real estate pictures, he would have a cowboy hat, and that was his brand, And people would maybe laugh. People would say, who's that real estate agent with a cowboy hat? But people will remember Cal Boyd. Right? Even I think now he's retired. It's been almost 8 years. We're still talking about Cal Boyd because of the cowboy hat. Right?
100%.
Yeah.
100%. Branding and personal branding, like you said, has a lot to do with a lot of stuff. How you feel about the brand, and how you feel about how you remember that as well.
Yeah. Amazing. So, what type of changes do you, or predictions do you have for the market? Qualification wise, mortgage wise, do you see any sort of not shift coming, but maybe a change in play from the Canadian government that could help more Canadians qualify for mortgages, or is it strictly come down to the supply and demand for you?
It's going to come down to supply and demand, but I also, and this is my own personal opinion, there's no statistics on this, but I've seen different generations think, like people live in the same generation think a little bit alike. So I remember when I first bought my property, and I remember the stories that my dad told me when we bought his first property. So when I bought my first property, I just wanted to get in. Did I buy the property that I wanted to live in for the rest of my life? No. Was it at the location that I wanted to buy? No. Was that the type of property that I wanted to buy? No.
Probably not.
Did I like my neighbors? You can ask my wife, Anna. No. And I wanted to buy it so bad, and we just got 15,000 cash from wedding gifts. So we saved that in a savings account, and when the right opportunity came along, we just deposit that money into a down payment, and off we go to the property that we could purchase. 25 years later, I had an underwriter working in my office, same age as I was when I started. He's working at a mortgage company, so we know how to approve loans. So I said to him, he disclosed to me he wanted to buy a property. I said, what are you waiting for? Have you done your numbers on yourself? And he goes, let's do them together. We did them together. We came with a budget, and he had the down payment, he had the credit, he had the income. And then the next step, say, okay, so find a real estate agent and start looking at homes. He goes, no, Camilo, I'm not going to buy. Why? I said, why? He says, because I want to buy downtown Vancouver in this particular neighborhood.
Right.
I said, okay, you're single, you're gonna get there. But the way to get there, and explaining my path. Start with something that you can do, pay down the mortgage, increase your equity via appreciation. In a few years, your income is going to be higher. Boom, sell and buy that. Because that happens to me. I sold my first property. I had enough equity. I have more income. I was able to buy a home, a bigger home, which I lived there for 22 years. He did not want to buy because he couldn't buy in the neighborhood, in the place, in the conditions that he had in his mind set up to do.
Right.
And there is no cure for that. So there is a way to get where you want to go, but sometimes it's not the way that you have in your mind. So if you don't have the maturity, and sometimes you have to suffer pain. Ask me if it was painful for me to live in that property. It was actually under construction because they had some issues in the strata. So there was dirt, trucks. Did I regret that decision? Not in a million years. Did I want to live there? No. Did I endure pain? Big time.
Yeah.
Uncertainty. But people nowadays want to avoid pain. They
Yeah, they're
want,
afraid of it. They're afraid of it.
we all
It
are.
makes them uncomfortable.
Well, ask me if I'm not uncomfortable with pain. Maybe with going in a podcast. I'm not a person who goes on podcasts often enough, but I know the value and I know where I want to be. And regardless of my emotions, I decide to take action in a certain direction. That's an important skill to have for everybody. In real estate, the same thing.
Yeah,
You,
100%.
you
In
get,
any business,
yeah,
you need to endure pain. You need to be uncomfortable to grow.
yeah. Giancarlo, your property has all
Yeah.
been rosy and perfect,
No,
and
no, no.
would it be worth it?
I mean, listen, what's easy doesn't last, right? And I think that in especially in real estate, the most successful real estate investors are the ones that survive the longevity. And look, I'll give you a great example from my own personal experiences. In 2020, we were making so much money, and I was investing in property, and my first investment was fantastic. It was probably the best. It was just a duplex, but it was probably the best. Like, even to this day, that duplex, it went up $120,000 in value without me even doing anything to it, right? And then I bought the condo where the numbers made sense. So I put the money down on the condo in 2020. And then, I had bought that year there, I had bought in June 2020, I had bought my first duplex. And then in December 2020, I had bought the condo. I had put the down payment for the new development condo. And then in February 2021, I had bought another duplex, right? And when I bought the third duplex, I was studying the cash flow, and the mortgage broker goes, fixed or variable? And I said, well, what's the difference in mortgage payments from fixed or variable? And he said, fixed is $740 a month, and the variable is $605 a month. And I said, give me the variable, because I said, I'm going to make an extra $130 a month in cash flow. And my projections with that variable was I was supposed to make positive cash flow $700 on a duplex, which doesn't exist anymore in Canada at all, okay? But positive cash flow, I was going to make $700. But then what happened was I bought it on variable, and a month after I went to the notary, the interest rates went up. And then 3 months later, they announced another interest rate hike. Next thing you know, fast forward from February to September, the interest rate went up 3 times. All of a sudden, my $700 a month cash flow became $110 a month cash flow. One more rate increase, and I was done. And what happened? The rate increased, and now my $700 cash flow came $20 a month in cash flow, right? And was that pretty? No. It wasn't pretty. My condo story, was that pretty? No. right? It wasn't pretty. And I had a decent turnout from that condo story because I see investors in Toronto losing their down payment, losing the condo, losing this, losing everything, right? And then the first duplex that I had, which was a great investment, we ended up getting, I'll never forget the date, August 13th, 2024. We had 225 milliliters of rain fall in Montreal in less than 3 hours, less than 4 hours. And I'm in property management. And I remember that night because it was raining and my house where I live, the land was starting to flood. So I was running to Home Depot to buy sandbags to put it around my land. And I called my property manager and I said, did any of our buildings have any floods? And he said, no. Surprisingly, I haven't gotten a call yet. Next thing you know, 3 hours later, we get a call to find out 6 of our buildings had flooded, but one of the 6 was my duplex in that I had bought. And I had called the insurance, and they said, I'm sorry, sir, but you didn't take the water damage insurance because at the time you said, well, I don't live next to water, so what do I need flood insurance for? Which makes sense because I would have said that because the house is not near water. And then I said, pardon my French, but I said frig. And I said, real estate is, maybe I had a good run, but it's not always easy. I endured pain, and I kind of got blinded by the fact that like I had 2 or 3 good purchases going on where I thought, hey, this is what it's going to be. But I got so blinded, and maybe not blinded, but maybe excited that I forgot about market shifts. And then it was not a rude awakening, but it was a reminder that it's not always easy, right? There is pain sometimes, and you need to endure that pain.
100%, Giancarlo. 100%. That's the difference. I read recently in social media, and I really love that. It goes something like this: if you are an employee, it's hard.
Yeah.
If you are self-employed, it's hard.
It's hard.
If you don't save money, it's hard. Saving money, it's hard. And it goes,
choose your hard.
Yeah, everything. Choose your heart.
Choose your hard.
I love that.
Yeah.
So
choose your hard.
So pick something and endure the pain, because if you don't do it, the pain is not gonna go away anyway.
Exactly. Well, Camilo, I mean, what would be one piece of advice you would offer? Maybe let's just take that regular family, that regular couple that we were talking about earlier, who has a dream of buying a home, and maybe they applied for a mortgage and they got denied, or maybe they went for a pre-qualification and they got, because I remember before I bought my first property, I went for a pre-qualification twice, and both the banks, I went for a pre-qualification twice. One bank, I won't mention any names, but one bank that I was a member of for 5 years prior had refused me. And I was thinking, like I could afford it. I know I could afford it, but I didn't meet the qualifications that the bank had. And I tried twice in 1 year with them, and they refused me twice, and I was discouraged, Then another bank actually approved me for my first 2 mortgages, which is funny because then after I got approved for my first 2 mortgages, the original bank that I had qualified to called me back and said, hey, you're pre-approved for a $300,000 mortgage. I said, oh, thanks. But, what would be one piece of advice you would offer that hardworking couple who has a dream of buying a home that maybe they've applied for a mortgage and didn't get the answer that they wanted?
Okay, super simple. In Canada, you will be able to buy a property. Now, I can. Nothing is guaranteed in life, but it's guaranteed because I say that because there's only 5 areas that any bank, look at in a person or in a family to grant an approval. So if they don't approve you for the amount that you want or the terms that you want, is because in some of those 5 areas something is missing. You just need to fix it, and then they will approve.
Yeah.
So if you say no, the next question is, what do I need to do in order to get this type of approval? But people don't ask that question. They just take it personal. And in my opinion, the mortgage professional, like I never say you're not approved. I will say something like, listen, you asked me for this amount of money. The bank will not give you that amount because of XYZ. This is what you can get. In order to get here, you can do it in several ways. Number one, number two, number three. And then the person goes, oh, okay. You see a path. Okay? And there's always a path. So that's my first piece of advice. Don't get discouraged. You will be able to buy. You just need to learn a little bit more on what is missing in your profile to get there. And the bank will give you money, regardless of your age, inclination, whatever it is. The second one is, and I'm gonna do a little bit of a self-promotion, start looking.
Call the mortgage lab.
Well, yeah, that too. But I was gonna say, start looking from day one at the cost of credit of your mortgage. That's the most important number. And if you wanna spend $30, read this book, From Debt to Zero, because I will explain how you can minimize the cost of credit. Just to give you perspective, if you negotiate the best rate, which we all do, and it's 25 basis points lower than X bank, on 300,000, you will save possibly $600 a year. Is that going to make you wealthy? Is that going to make a big change in your life, in the big scheme of things? Well, no. Over 5 years, you may save $3,000. It's worth it.
Yeah.
If you minimize the cost of credit, the minimum, that if you start applying those concepts, the minimum amount of money that you can save for your family would be in the range of 50,000 and up. So there is no comparison. It's apples and oranges. You cannot negotiate a lower rate in order to save 50,000, 100,000 in interest. The math doesn't add up. So what is the other 5 areas? I explain in my payoff framework within that book. And you just apply it. You don't need to call me. Apply what says the book, and you will get it. If you want my advice, of course, I'll be super happy to have a consultation, and I create maps, mortgage analysis plans on how to reduce to the minimum the total interest, which I explain in my book. If you look at the other side of the coin, the total cost of credit is the total profit of the mortgage, what the banks call the lifetime value of a client. So when you sign the documents, the bank is already thinking, okay, if I keep this customer, it's going to bring me, it's going to be in the range of hundreds of thousands of dollars in interest for having this mortgage. But nobody reverse engineer the process to see how you can reduce it. And that's why I was so excited to write the book.
Amazing, amazing. Well, I mean, that's all great, my friend. I really appreciate you sitting down and having this conversation with us. One last thing before we go. If they want to get in contact with you, how could they reach you?
Easy. Google my name, Camilo Rodriguez. I'm on LinkedIn. If they Google my company, Mortgages Lab, they fill out, they'll have all my contact details there. They can send me an email, text, call me. They can go to my Instagram page.
Amazing.
Nowadays, it's easy to contact someone if you really want to talk.
If you really want to. Yeah. If you really want to, for sure. Camilo, my friend, thank you very much for coming on the show, for having a quick word with us. I really appreciate your time. It was a great conversation. And for anyone watching, whether you're watching on YouTube, Facebook, Instagram, Apple Podcast, or Spotify, be sure to like, comment, follow, and subscribe. Until next time, we'll see you guys later.
Giancarlo, thank you very much. Appreciate it.
Thank you.